Hello everyone, good morning again. Let's come together to conclude the custom valuation today under session 3. Earlier we had concluded that whenever goods are coming from abroad, then the exporter, after obtaining the guarantee letter from the importer under letter of credit, shall forward the goods from the port of exportation to port of importation. And at the port of importation, custom officer shall be liable to charge duty on such goods, for which importer shall be liable to compute duty by multiplying the rate of duty with the assessable value. Assessable value is the value at which we have to compute duty, and since duty has to be computed at the Indian port, therefore, this assessable value shall be taken as the aggregate of all the expenses incurred from the beginning till the delivery of goods at the Indian port. Under this valuation, there will be many expenses which we had already seen under Rule 10, bifurcated under two categories, namely Rule 10.1 and Rule 10.2. Under Rule 10.2, we had considered the implied additions of freight and insurance, which has to be added while computing the assessable value, irrespective of the fact whether they are actually given in the question or not. However, under Rule 10.1, their list of expenses shall have to be added while computing assessable value only if they are specifically given in the question, which we had concluded under session 2 in the name of dismantling charges, selling commission, royalty for resale. Demurrage interest shall not to be considered because they are post-importation expenses. However, we have to consider only pre-importation expenses while computing such assessable value. So let's come to the valuation rules which we had started under session 2. Under valuation, section 14 has been introduced of Custom Act, which says that under section 14 there will be two subpart in the name of section 14.1 and 14 subsection 2, wherein under section 14 subsection 2, if central government has notified certain value of any article to stabilize the economic fluctuation of that article, then such value which has been notified by the government only for the purpose of computing duty will be known as tariff value. And if on any article the tariff value has been notified, then duty shall always be computed on such tariff value. However, if tariff value is not given, then the valuation shall be done under section 14 subsection 1, which delegates the power to central government for determining the assessable value under different circumstances on the basis of such power which is given to the central government by Parliament under section 14 subsection 1. Central government has introduced two different set of rules, namely Determination of Price of Imported Goods Rules 2007, or we can also consider this price as value of imported goods. Therefore, we also name these rules in the name of DPIG rules, where D stands for determination, P for price, I for imported and G for goods. And central government has also drafted another set of rule in the name of custom determination of price of exported goods rules, which can be abbreviated as DPEG rules. Here again, price refers to the value of goods. So the name of rule could be like determination of value of imported or exported goods, or determination of price of imported or exported goods. These rules were established in the year 2007. Under DPIG rules, we had started in the previous session that under Rule 1, the title has been given, the name, the heading of these rules have been given, whereas Rule 2 comprises of definition of different terms being used under these rules. Further, under Rule 3, they concluded that assessable value shall be taken as the transaction value along with additions to be considered under Rule 10, which we had already covered under Session 1 and Session 2. In session 1, we had concluded Rule 10 sub Rule 2, and under session 2, we had concluded Rule 10 sub Rule 1, wherein different additions needs to be made while determining the assessable value. Today, we'll conclude this topic by enhancing the provisions of Rule 3. Here under Rule 3, we have two sub-rules to be understood in detail, because from this rule, sometimes theoretical provisions can be asked in the exams. Rule 3 have two sub-rules in bifurcation, Rule 3 sub-rule 1 and Rule 3 sub-rule 2. Rule 3 sub-rule 1 says that assessable value for imported goods shall be taken as the aggregate of transaction value and the additions made under Rule 10. These Rule 10 we had already covered, and the transaction value is the value at which goods being sold, that is the selling price, or the price specifically mentioned by the seller in the invoice while selling the goods, exporting the goods to the buyer or importer. Now Rule 3 sub Rule 2 states that this transaction value, this invoice price, this selling price can be considered, it shall be considered while computing the assessable value only if all of the following conditions are satisfied. That is, they provide three basic conditions under Rule 3 sub Rule 2 for permitting the transaction value to be considered for determining assessable value under Rule 3. That is, if these three conditions get satisfied altogether, then only this transaction value can be considered, under which the additions given under Rule 10 to be added for computing the assessable value under Rule 3. And if any of such conditions does not get satisfied, then by proceeding sequentially, the assessable value can be determined under Rule 4 or Rule 5 or Rule 6 and so on instead of Rule 3. Always remember that custom valuation rules shall have to be applied proceeding sequentially. Proceeding sequentially means these rules have to be applied in sequence. That is, an assessee cannot directly jump to Rule 5 for determining the assessable value. They shall always determine this value initially primarily under Rule 3, subject to the conditions given under Rule 3. And if these conditions get satisfied, then always you have to apply Rule 3. However, if any of this condition does not get satisfied, then by proceeding sequentially, valuation shall be done under Rule 4 or Rule 5 and so on. That we will see over the period of time. So now, if we would like to conclude the conditions on the basis of which transaction value has to be taken under Rule 3, then the first condition is that there shall be no restriction upon the buyer by the seller on the goods after their sale. I would like to conclude this topic with the help of an example. Let's say that Mr. Harinder in India imported a bike from Mr. Huimui from Japan, who sold the bike for rupees 50,000 to Mr. Harinder. However, Mr. Huimui, that is the seller, imposes a restriction on buyer, that is on Mr. Harinder, that once the bike has been supplied to Mr. Harinder, then Mr. Harinder shall be liable to inform, to intimate Mr. Huimui in relation to the person he makes sit behind his back. That means whenever and wherever Mr. Harinder uses this bike for any purpose, then he shall be liable to inform about such usage to Mr. Seller. Now tell me, will such kind of restriction can be imposed during sale of goods? Because sale means transfer of ownership for some consideration. And if Mr. Harinder have the ownership of this bike, then he has the right to use these goods as per his own desire. He can make any person sit behind his back on the bike without informing anyone. However, if Mr. Huimui imposes such restriction on Harinder to intimate each and every time while making anyone sit behind his back on the bike, then make it sure that the ownership of bike has not yet been transferred. And if ownership has not yet been transferred, then obviously there could be no sale. And if even without sale, goods are being transferred from one place to another place, then always assume that there must be any relationship between them due to which goods are moving between them. For say, I could say that Mr. Huimui belongs to head office of a company and Mr. Harinder becomes the branch in charge of that company in India. And head office is supplying goods to branch for its usage in the business purpose. And head office always demands the branch coordinator to inform the usage of goods being supplied to them, that whether such goods being used actually for the business purpose or not. And if due to such relationship bike has been transferred from one place to another place, then lawmaker says that generally we presume that because of such relationship, the price shown in the invoice in the name of transaction value, the price shown in the invoice in the name of transaction value must have been manipulated for the purpose of tax evasion. That means lawmaker presumes that the bike must be having a higher value. For example, in the given case, we have the value of rupees 25 lakh. Once we sell such kind of bike to any other person without restriction, however, the same bike if supplied to any person upon whom we imposes restriction even after the transfer of such goods, then the price shown in the invoice must have been manipulated or reduced only for the purpose of tax evasion. And this tax evasion could be possible by reducing the price shown in the invoice, on the basis of which, on the basis of this transaction value, under Rule 3, the assessable value shall be determined. And if the transaction value has been manipulated, then obviously assessable value must always be manipulated for evading, for avoiding, for reducing the tax to be payable by the assessee. Therefore, lawmaker says under Rule 3 that to avoid such tax evasion, by avoiding this manipulated value shown in the invoice by the supplier to the recipient, when supplier imposes restriction even after the transfer, then under such case, Rule 3 can never be applied. That is, such transaction value shall not to be considered. This transaction value shall not to be considered while determining the assessable value. And if Rule 3 cannot be applied, then by proceeding sequentially, the assessable value shall be determined under Rule 4. Okay. Now further, lawmaker also says that if Mr. Huimui supply the similar kind of goods, supply the identical kind of goods, supply the same goods to any other person in India without restriction, then only Rule 3 can be applied. then only rule 3 can be applied, where while computing assessable value, transaction value can be considered. That is, the price shown in the invoice is to be considered, in which additions under rule 10 in the name of freight, insurance and other expenses, other expressed additions, we can add it thereupon to determine the assessable value. However, lawmaker says if the similar kind of product is being supplied to Mr. Raman with restriction for rupees 25 lakh only, that is, even if there is any restriction by the supplier to the recipient, but the transaction value shown in the invoice has not been manipulated, which can be compared with the other supply made without restriction. That is, the supply made to Mr. John without restriction is for 25 lakhs and supply made to Mr. Raman with restriction is also rupees 25 lakh. That is, the price of goods does not influence, the price of good does not affected, then rule 3 can be applied, because lawmaker says the transaction value is not being manipulated. Therefore, on the basis of such transaction value, assessable value can be determined under rule 3 by adding the extra additions under rule 10 on such transaction value. That is, we can say that in case of restriction, there are certain exceptions which are also known as permissible restrictions, which can be asked in question under theoretical mode. Examiner may ask, what are the permissible restrictions under custom? Permissible restrictions means there could be certain restrictions which can be imposed by exporter on importer even after the sale of goods, which does not influence the price shown in the invoice as transaction value by the exporter, and therefore, since price has not been manipulated, therefore such transaction value can be considered under rule 3 for determining the assessable value, even if supplier imposes any restriction on the buyer, and it would amount to manipulation of price, then rule 3 can never be applied, because the transaction value herein has been manipulated, on the basis of which duty cannot be computed. And whenever rule 3 cannot be applied, then by proceeding sequentially, we have to compute such value under rule 4, 5 and so on. However, in case of permissible restrictions, we presume that the price has not been manipulated, due to which even after such restriction, the price declared in the invoice as transaction value can be considered for determining assessable value under rule 3. The first exception to this, let's consider it as the last exception. This is non-influencing restriction. This is the same restriction which we did in the example. Here we says that Raman is also being the branch head of another branch of Mr. Huimui, and Mr. Huimui being head office supply goods to Mr. Raman at the transaction value of 25 lakh only. This is the price at which these goods being supplied to any other person even without restriction. That is, because of restriction, the price of invoice or the price of goods under invoice has not been influenced, due to which rule 3 can be applied as a permissible restriction. Okay, so we can say that in case of restriction, there could be two cases. Either goods can be supplied with restriction or without restriction. If goods are being supplied with restriction and the price is shown to be manipulated, how can we conclude that the price in the invoice has been manipulated? You can make a comparison with other supply, other importation made to any other person at or about the same time without restriction. Then lawmaker says In such a case where after restriction the price has been manipulated, rule 3 can never be applied, due to which by proceeding sequentially we have to go for other rule. However, if there is no restriction, then directly rule 3 can be applied. However, as per the exception, we can also conclude that even if under case of any restriction the price has not been influenced, which can be determined by making a comparison, then under permissible restriction rule 3 can be applied, wherein such transaction value shall be taken as the assessable value after aggregating the different additions given under rule 10. Okay. Further, next it says that if there is any restriction because of statute, because of law, then also we presume that the restriction made because of law does not amount to manipulation of the transaction value in invoice. Therefore, even after such restriction, rule 3 can be applied. The transaction value can be considered for assessable value. For example, in order to have a control on the sale of different arms and ammunition, that is weapons, which are dangerous for the social security, the lawmaker has created a law in the name of Arms and Ammunition Act. Under this Arms and Ammunition Act, there are two conditions. Firstly, the weapons, the arms can be sold only to the license holders. That is, not everyone or anyone can purchase these weapons. Only this instrument has been sold to the person who has already issued license on his name by government. And government provides this license to only two kind of people, either one who are already involved in the defense mechanism, such as army, navy, defense or police, or two, the person wanting the license is a prominent personality, a popular personality whose life can be at stake. For example, politicians, celebrities, cricketers. If I say that Aishwarya Rai traveling throughout the world is having an insecurity that one can kidnap her or something like that, so for her social security she can keep a pistol along with her after obtaining a license from government under this act, Arms and Ammunition Act. And if any person is found to kept such weapon without obtaining any license from the proper authority, then such person shall deem to be considered as terrorist. The live example of this particular case is Mr. Sanjay Dutt. Mr. Sanjay Dutt has found guilty after keeping AK-47 with himself, even though he hasn't used it at all, but he found keeping this gun at his place without obtaining any license. Therefore, he deemed to be treated as terrorist, for which he had to suffer the penalty and imprisonment. For example, Mr. Christine, located in US, is our biggest supplier of arms and weapons. Now he supplies bullets to Mr. Ganesha, a license holder in India. And Mr. Ganesha is purchasing 100 bullets to be used in gun. Now Mr. Christine shall ask Mr. Ganesha to maintain a track record of the bullets being used by Mr. Ganesha over a period of time. And Mr. Ganesha shall always inform Mr. Christine the usage of such bullets he purchased from him. This intimation, this restriction of intimation is only to have a control in the society. That is, if this law does not survive, then every person must have a pistol in his pocket along with a mobile phone. And nowadays, we people does not have that much patience. Therefore, in case of any dispute, any difference of opinion, we might get agitated and take out a pistol to shoot out the other person, which might result in social insecurity. Therefore, lawmaker says that not every person can keep this instrument, keep this weapon with themselves, and whosoever is keeping it with themselves, they shall be liable to inform his seller every time that whatever bullets they have purchased, where all they are using them all. So that the only intention behind this law is to keep a tracker of all the instruments, all the weapons being sold to other person. If let's say Mr. Ganesha has purchased 100 bullets and after 6 months he is asking for another 100 bullets, then Mr. Christine will definitely ask him that where Mr. Ganesha has used those old 100 bullets, after which only he can supply another bullets. Now if Mr. Ganesha inform Mr. Christine that he has used the 100 bullets for so and so particular purposes which are in the ambience of law, then only after that Mr. Christine can make further supply of another bullets to him. So can you think that even after this restriction which is imposed under law, even after this restriction which is imposed under law, the price of goods must have been manipulated? No. Since this restriction has been given under statute, and because it is given under statute, therefore it has become statutory obligation, that is compulsion under law, due to which both of them are bound with this provision and seller has to impose restriction on buyer. But because of this restriction, because of the statutory restriction, the price of goods must not have been manipulated. And since the price of goods must not have been manipulated, therefore the price shown in the invoice can be considered as transaction value under Rule 3, upon which assessable value can be determined by adding the additions under Rule 10. Further, they says that there could be certain geographical restrictions. Now, geographical restrictions means the restrictions imposed by seller on buyer to make the supply of such goods within their geographical boundaries. For example, if I say that Iraq is the biggest supplier of petroleum crude oil products, and petroleum is a product which has increasing demand over the period of time but reducing supply because it gets manufactured over the period of time. It is generally said that a crude oil can be manufactured over the period of 2000 years after the decade of or the dead bodies of different animals and human beings. So it's next to impossible to create petroleum from now onwards within a shorter span, due to which its supply is very much limited, very much scarce. Now, the Iran-Iraq suppliers, who are the major suppliers to the global economy, they have seen that the person purchasing petroleum from them started black marketing of it. For example, if I say that Mr. X in India needs 10,000 metric ton of petrol, but he purchases 50,000 metric ton of petrol, that is, he had 40,000 metric ton petroleum in his surplus, which he keeps on preserving in his stock. And since he is procuring the higher amount of scarce resource such as petroleum from the market, due to which the supply in the market gets reduced over a period of time, and supply getting reduced because he is black marketing, he is keep on overstocking of this product in his warehouse, and its demand is getting increased, it would result in increment in price. And once Mr. X has decided that the price of this petroleum gets increased over a particular point of time, then he can start releasing his overstocked petroleum at such increased price. This is known as black marketing or jamakhori, in which the wholesalers or retailers start preserving the stock in surplus, so that over the period when in market supply gets reduced and the price gets increased, they can release the stock at an increased price in the market. So Over the period, Iran-Iraq Suppliers has created an organization in the name of OPEC, Oil and Petroleum Exportation Council, and they have realized the concept of this black marketing, which was resulting in irrational distribution of this scarce resource throughout the global economy. Therefore, in order to have rational distribution means since it is a scarce resource, therefore it needs to get distributed rationally among different countries in the way they are being actually demanded in their market. OPEC has imposed restriction on all the buyer countries that whatever the petroleum being purchased by the different importers from different countries from OPEC, they shall be liable to resell such product within their geographical boundary. They cannot resell such product to any other country. They cannot resell such product to any other country. And since now such product cannot be resold to any other country, therefore, because of this geographical restriction, black marketing of this scarce resource has been reduced. Geographically, restriction means the buyer or the importer who purchases the imported goods shall be liable to resell or resupply such goods within their geographical territory, and they cannot sell it to any other place outside their premises, outside their geographical territories. This concept has been only introduced for the rational distribution of such scarce resource. They don't want that petroleum scarce resource can be black marketed in the market. Therefore, for the rational distribution, they has imposes this restriction. Now, what do you think? That even after such restriction, would the transaction value of the goods gets manipulated? No. It generally does not amounts to manipulation. Therefore, it has been allowed as permissible restriction, which says that even after geographical restriction, since the price of goods does not get influenced, therefore, even after this permissible restriction, transaction value can be considered for computing assessable value under Rule 3 by adding additions under Rule 10 thereupon. So, we can say that under Rule 3.1, it says that assessable value shall be taken as the aggregate of transaction value and additions under Rule 10, where transaction value is the price paid or payable by the buyer to the seller as shown in the invoice. Therefore, it is also known as sale price or invoice price. But this transaction value can be considered only if three conditions are being satisfied. First condition is that seller does not impose any restriction on the buyer, wherein we have an exception wherein we also says that there could be three permissible restriction with which we presume that the price of goods has not been manipulated. Therefore, in these exceptional restriction cases, we can consider this transaction value to be determining assessable value under Rule 3, wherein we have three restrictions. One, statutory restriction, any restriction imposes under statute or law. Geographical restriction, which is because of rational distribution of any resources, or non-influencing restriction, any restriction with which, even after which, the price of goods does not being influenced. Then in these three cases, this transaction value can be considered under Rule 3. Now, another condition under Rule 3 will be that there must be quantifiable data at the Indian port where the custom duty has to be computed. This we can understand with the help of an example. Let's say our exporter export goods to the Indian port at an export price of rupees 10 lakh, and exporter requested the importer that importer shall be liable to pay selling commission to the agent of exporter located in India. We had already covered such kind of expense under Rule 10.1. So, exporter, on the request of exporter, importer pays selling commission on behalf of exporter to his agent located in India, and such commission is said to be rupees 2 lakh. Since the commission is certain, it is known, it is quantifiable, its amount, its quantity is quantifiable at the Indian port itself. Therefore, lawmaker says Rule 3 can be applied. That is, while computing the assessable value, such quantifiable information shall get added in the assessable value along with freight and insurance given under Rule 10(2). However, if any information related to imported goods are not known or their quantity cannot be determined, they cannot be quantifiable at the Indian port where duty has to be computed, then we can never ever apply Rule 3. Because Rule 3 says that any consideration paid by importer to exporter shall get added in the assessable value. But if the information related to the expense paid by importer to exporter is not ascertainable at the Indian port, as in the given example, where exporter says to the importer that pay selling commission to my agent located in India at the rate 5% of resale price of such goods in the Indian market. That is, the condition of commission is that importer shall sell such goods in the Indian market, and whatever the Indian market price will be, its 5% shall get given to the exporter's agent. Now obviously at Indian port where goods being unloaded and where assessee has to compute duty thereupon, for which assessable value is required, the Indian market price is not known to the importer himself, because it is not ascertainable that where can be the goods be sold. It might be sold at the Mumbai itself where it has been unloaded, or it might be sold to the Assam or Jammu or Kerala, etc. And since the buyer's premises could be any place throughout India, therefore their freight, their cost of transportation could vary. If goods sold in Mumbai itself, then the transportation cost might be very less. However, if the similar goods being sold to Assam to any buyer thereof, then the cost of transportation will obviously get increased. And because of this, the actual selling price, the actual Indian market price cannot be determined at the Indian port, due to which this amount of selling commission is not quantifiable, cannot be determinable at the time of importation of such goods. Due to which, since the information is partially unavailable, therefore Rule 3 can never be applied thereof, rather by proceeding sequentially, the assessable value shall be determined under Rule 4, 5 and so on. That means Rule 3 can be applied only if all the information related to imported goods are quantifiable known at the Indian port. Will that be fine? So according to second condition, the information must be quantifiable at the Indian port where duty has to be computed. If this condition does not get satisfied, then Rule 3 cannot be applied, wherein transaction value shall not to be considered for determining assessable value. Finally, it says that third condition is the exporter and importer, the seller and buyer, must be a non-related party. That is, there must not be any relation between seller and buyers, exporter and importer, because generally we presume that if there is any relation between two parties, then the price shown in the invoice by the exporter as transaction value must have been manipulated for the purpose of tax evasion. And if such kind of manipulation has been done, then such transaction value shall never to be considered for determining assessable value under Rule 3. And as and when Rule 3 can never be applied, therefore, by proceeding sequentially, valuation shall be done under Rule 4 or 5. For example, Mr. Huimui from China export goods to his related party, that is Mrs. Huimui, his wife, at a transaction value of rupees 5,000. So lawmaker says that if there is any relation between exporter and importer, that is seller and buyer, therefore we presume that the price shown in the invoice must have been manipulated for the purpose of tax evasion. That is, the actual price of such goods might be 75,000 if these goods are sold to non-related party. But since sale has been showed to related party, therefore seller has reduced the invoice price from 75,000 to 5,000, so that on the basis of such reduced price, duty shall get computed. And if transaction value gets reduced, then obviously assessable value gets reduced, subject to which custom duty shall get automatically reduced, amounting to tax evasion. Therefore, lawmaker presumes that we have this practical exposure that if there is any relation between seller and buyer, then the price in the invoice could have been manipulated, due to which we shall not apply Rule 3. Because the third condition under Rule 3.2 says that there must not be any relation between exporter and importer. And if Rule 3 cannot be applied, then by proceeding sequentially, its valuation shall be done under Rule 4, 5, 6 and so on. However, if these goods are being sold to non-related party, that is Mr. Hui exporting goods to Mr. Mohan, being a non-related person for rupees 75,000, then Rule 3 shall be applicable, as the condition under Rule 3.2 has been satisfied. That means the price shown in the invoice must be taken for computing assessable value thereupon. However, there is an exception to it, which says that if exporter export goods to any of his related party, for example, in the given case, Mr. Hui selling goods to Mr. Chow Mao, his brother, and he does not manipulate the price in the invoice even to the sale to his brother, then lawmaker says that Rule 3 can be applicable by determining the assessable value on such transaction value. That is, so we had rejected Rule 3 only because of one purpose in case of related party transaction, that the price shown in the invoice could have been manipulated for tax evasion. But if there is no such manipulation, then obviously we can consider this transaction value for the purpose of computing assessable value. Is that fine? So sir, in this case we can say that Rule 3.2 have three conditions: that seller does not impose any restriction on buyer post sale, all the information related to imported goods must be quantifiable at the Indian port, and seller and buyer must not be a related party. If all these three conditions get satisfied, then this transaction value shall be considered for determining assessable value by adding the different additions under Rule 10. But we have a doubt that who is related party. So for this purpose, they have given a definition. The definition is given under Rule 2, Sub-Rule 2. As told in the initial stage, we had seen that all the definitions of different terms being used under these rules, the definition has been given under Rule 2. And on the basis of such definition, we will decide who will be the related party for the purpose of customs. Under Rule 2, Sub-Rule 2, 7 parties has been considered as related party. The first one is any officer or director of an entity. Any officer means the employee, and director again being the employee who actually controls and manages the company as a whole on behalf of its shareholders. Second one, this is partner in a partnership firm. Now partner has been expressly mentioned separately because partner is neither the officer nor the director of the organization. That is, it is not the employee. The officer and director refers to the employee, but the partner in a partnership firm refers to the owner itself. So they says the partner himself will also be treated as related party of any legally recognized firm. Legally recognized firm means any firm which is having legal existence under law. This legally recognized can be in two ways. One, we had Indian Partnership Act in India, wherein a firm can be formed even without registration. So that is, if a firm is without registration, still its partner shall be treated as related party. And we have another Limited Liability Partnership Act, where it is compulsory to get the firm registered. So even if it is registered or not, in both the cases, the partner in the firm shall be treated as related party. That means in first two cases, the relation has been created because of business. So we can classify them as business relatives. Okay. Then second one says any family member as per Companies Act. Companies Act defines any person who is directly and immediately related to the person. That is, if any person is directly or immediately related to any person, brother, parents, spouse, children, grandchildren, grandparents and so on, then they shall be treated as family member. The basic definition has been given under Companies Act, which we can refer to our detailed lectures. We can conduct those topics in the detailed lectures thereof. So in any case, the third relation shall be created due to family. So first two relations shall be because of business, second relation is because of family. Now the next one they say is that any person directly or indirectly controls the other person. That means if I say that there is a company in the name of A Limited which is having control over B Limited and B Limited is having control on C Limited. So A and B are related party because they are under direct control. B and C are again related party because again they have direct control. As well as A and C shall also be treated as related party because of indirect control therein. So if any person having direct or indirect control on the other person, in both the cases they shall be treated as related party. Next, this says two or more persons under the common control of the third person. If I say that A Limited holding shares of B Limited majorly and parallelly he is also holding shares of C Limited, so A and B shall be treated as related party. There is no doubt because in both the cases they have direct control. As well as B and C shall also be treated as related party because they are under common control. So if a common person controlling the two different entities or person, then those two entities shall also be treated as related party. Okay. Then next one they say is two or more persons together controlling the third person. Two or more persons together controlling the third person, that is A Limited and B Limited both are controlling C Limited. Both are holding sufficient appropriate amount of shares in C Limited. So sir, in any case A and C are related party, B and C are related party because they are under direct control, as well as A and B shall also be treated as related party because together they are controlling the third common person. The third common person. The third common person is that means we are talking about the specific person. This is reverse of the previous case. In all these three cases, the relation has been created because of control. So we can say that here the relation is because of controlling action. Okay. And the last one they say is one person holding 5% or more outstanding voting securities. Now what do you mean by outstanding? Outstanding means partly paid up. Outstanding means partly paid up. Where the liability is still outstanding, it has not yet fully paid up. So it says where the person is having more than or equal to 5% of partly paid up those securities which are having voting rights therein. That is generally the equity shares, and in some cases even preference shares could have the voting rights, where for a certain period they doesn't get their fixed dividend. So if all these three conditions are satisfied, then such shareholders shall also be treated as related party. That means the fourth relation is because of shareholding relation. So we can conclude that under customs, relation can be created only because of four reasons. 1, either because of business. 2, either because of family. 3, either because of control over other. And fourth one is because of shareholding relation. If any person gets covered under any of these four categories, that is any of these four items, then such person shall be treated as related party upon whom Rule 3 cannot be applied, because the value decided in the invoice by them treated to be manipulated and has been rejected under Rule 3. So we can conclude that Rule 3, subject to the conditions given under Rule 3(2), if transaction value has been selected upon which additions under Rule 10 has been added, then only Rule 3 shall be applied. And if any of such condition has not been satisfied, then we have to proceed sequentially under Rule 4. Further, there is a small Rule 12 which also says something. Rule 12 says that it may be possible that assessing officer is doubtful in relation to the transaction value declared by the assessee. The transaction value shown in the invoice by the assessee is found to be doubtful by the assessing officer. And if such doubt arises, then officer shall be liable to ask for sufficient and appropriate evidence from the assessee. And assessee shall be liable to provide evidence thereupon. And if even after obtaining such evidence, the officer does not get satisfied, then he have an authority to reject such value as mentioned in the invoice as transaction value. He has the authority to reject such value for the purpose of computing assessable value. This is given under Rule 12. Rule 12 says that whenever assessing officer is doubtful about any amount, any transaction value, then he shall ask for evidence, and if even after obtaining such evidence he does not get satisfied, then he can reject such value for the purpose of computing AV. And if Rule 12 gets applied, that is the value is getting rejected by assessing officer, then also by proceeding sequentially, the assessable value shall be determined under Rule 4. That is, we can say that under two circumstances we can proceed from Rule 3 to Rule 4. If there are only two cases when we can proceed from Rule 3 to Rule 4. 1, if Rule 3(2) conditions does not get satisfied, that is, either seller imposes restriction on buyer, or there is a relation between importer and exporter, or the information related to imported goods are not quantifiable at port, then, or the value of transaction value mentioned in invoice has been rejected by assessing officer under Rule 12. If either of the condition gets arise, then valuation shall be done under Rule 4 instead of Rule 3. And Rule 4 says that in such a case, the value of transaction value, Rule 4 says that value of identical goods shall be taken as your assessable value. Now, what do you mean by identical goods? Let's see. Identical goods are those goods which are same in all aspects. Here aspect means features. So those goods whose features are same almost except minor differences. There could be small minor differences thereupon, and manufactured and imported from same country of exportation. That is, the country from there they have been imported to India must be same. If both these conditions are satisfied, and such goods must be imported in India at or about the same time. At or about the same time means either on the same day when goods being imported by our client, or in the nearest past when any other person imported such goods thereupon. For example, I can say that Mr. Ram imported iPhone X in black color from US from Mr. John, whose transaction value in the invoice is shown as rupees 25. Now, finding this value as doubtful, assessing officer asked Mr. Ram to supply evidence validating such amount. But even after obtaining such evidence, officer does not satisfied with such value. Then officer can reject the value, this rupees 25 transaction value, for the purpose of computing assessable value under Rule 12. And if such value has been rejected under Rule 12, then Rule 3 can never be applied. And if Rule 3 cannot to be applied, then by proceeding sequentially, its value shall be determined under Rule 4. Now, Rule 4 says that find out any identical goods which are imported at or about the same time. At or about same time means Ram has imported goods on 15th of September. So, check from the national records of custom. All the custom goods imported in India from any port has been recorded in an electronic system, from where importer or assessing officer can determine that whether any identical similar goods being imported in the nearby time or not. So on 15 September, Ram importing iPhone X at rupees 25, which has been rejected by officer under Rule 12. Now officer in collaboration with assessee has to determine the value of identical goods. So on checking the national records, they found that on particular 15th September, no such identical goods being imported in India. But in the nearest past, on 25th October, it was found that Mr. Abdul from other state imported iPhone X in white color. That is, all the features are same except minor difference. The minor difference is of color, which does not impact the original features of mobile phone. So this is the identical goods, because there must be three conditions. All features must be same except minor difference such as color, imported from same country of exportation at or about the same time. About the same time means nearest past. So it was found that Mr. Abdul imported the similar identical goods, same identical iPhone X from US at rupees 42,000 20 days back. And since Abdul imported at a correct price, therefore on Abdul Rule 3 must have been applied, due to which while computing the assessable value of Abdul, 42,000 must have been considered under Rule 3, in which freight and insurance and other expenses under Rule 10 must have been included. So Rule 4 says that whatever the value of Abdul, the assessable value of Abdul shall be taken as the assessable value of Ram. Now for Ram also, this 42,000 shall be considered, in which different additions under Rule 10 needs to be added. But what if Ram importing iPhone X in India for the first time, that is, no such identical goods have been imported in India as of now, then by proceeding sequentially, we shall forward to Rule 5, which says that if identical goods does not exist, then you can consider the value of similar goods as your assessable value, where similar goods means goods which are although not same in all aspects, that is, whose features are not same, all features are not same, but are commercially interchangeable. Now, what do you mean by commercially interchangeable? It means that is, such goods must be substitute. That is, if this particular item which is being imported in India, they were not being sold in India, then prior to that, which was the other substitute goods which can be sold in that place? For example, if I say that in the given example, Ram importing iPhone X for the first time, and prior to this, iPhone X never being imported in India, then we can consider the value of iPhone 8, which was commercially interchangeable, which was the substitute before iPhone X being imported by Abdul. So now, since not all features are same, iPhone X and iPhone 8 cannot be comparable in all features. Therefore, iPhone 8 shall be taken as similar goods, and whatever the value of similar goods as determined by such assessee shall be taken as the assessable value under Rule 5. So, by proceeding sequentially, we can conclude that if Rule 3 cannot be applied, then go for Rule 4, where value of identical goods needs to be considered as AV. If Rule 4 is not applicable, then apply Rule 5, where value of similar goods to be considered as assessable value. Now, I am just briefing the concept. We'll consider all these rules individually by taking up the practical questions alongside. Just have a brief look right now, that if identical goods, similar goods, both are not available, then by proceeding sequentially, we shall forward to Rule 6. Now, Rule 6 says, it's just a theoretical rule which says that unlike Rule 3, notwithstanding anything contained in Rule 3, under Rule 6, there is no need to proceed sequentially under Rule 7 and Rule 8. That is, Rule 8 can be directly applied before applying Rule 7 and vice versa. That is, Rule 7 can be applied without applying Rule 8. It is just a theoretical provision. We can understand the base of this provision on the basis of some analysis. Now, let's see. If identical and similar goods are not available, then we have two other ways of determining the assessable value. Lawmaker says that since assessable value has to be computed at the Indian port, therefore, either we can consider all the expenses incurred on imported goods and shall take aggregate of all such pre-importation expenses, whose aggregate shall be considered as computed value, where such computed value shall be taken as assessable value under Rule 8. Ma'am, this is the same thing we did under Rule 3. In the beginning itself, we drafted the same concept. But sir, there is a difference between Rule 3 and Rule 8. Under Rule 3, all the expenses incurred by the exporter has been shown in the transaction value or FOB value, in which we had added different additions under Rule 10. But Rule 3, wherein the transaction value declared by exporter as the aggregate of all his expenses has been rejected under Rule 12, due to which Rule 3 could not be applied. Therefore, under Rule 8, we are asking the exporter to provide us the breakup cost of each and every expense incurred by him on exporting such goods. Now, the transaction value, the invoice price shall not to be considered, rather we have to consider each and every individual expense incurred by the exporter on exporting the goods, and if all such expenses are given by exporter to importer, then Rule 8 says that you can consider all these expenses and take up all expenses incurred up to the Indian port. The aggregate of all of them, all pre-importation expenses, are known as computed value, which shall be taken as your assessable value under Rule 8. And this could be possible that exporter is ready to tell you the details of all his expenses only if he is a related party. That is, it may be possible that exporter is an head office and the importer is a branch. Then in such related party transaction, exporter, the head office might get ready to tell the branch all the breakup cost of expenses incurred by him. And if due to such relation it is possible to obtain the breakup cost of all the expenses, then assessee shall be eligible to apply Rule 8 for determining the assessable value without applying Rule 7 as said under Rule 6. So since all the breakup cost is available for you, so it's better to take the aggregate of all such expenses for determining the assessable value under Rule 8. However, if there is no relation between importer and exporter, that is, the exporter is not ready to share his breakup cost with you because he is insecure that if you will be aware to know, if you are aware that what is his breakup cost, then you might become his competitor by manufacturing such goods on your own itself. So it might be possible that exporter doesn't share his breakup cost with you. Then assessing officer says that you can apply Rule 7, wherein you have to sell such imported goods in the Indian market after furnishing a security bond. Since at port you haven't paid duty yet because of non-determination of assessable value, therefore, on a basis of provisional assessment, you shall be liable to deposit a security deposit with the department and can release few units from the department and subsequently sell such units in the Indian market. If those goods get sold in the Indian market within a period of 90 days, then you will be eligible to deduct all the post-importation expense therefrom. That is, any expense incurred from port till the market, then all such expenses needs to get deducted from the Indian market price so as to determine the value at Indian port. And what all could be the post-importation expenses, such as we had already covered under Rule 10, buying commission, demurrage charges, installation charges, taxes or duties paid in India, profit margin of importer, advertisement, selling and distribution, freight and insurance from Indian port to Indian market, and etc., etc., etc. So all the post-importation expenses incurred after Indian port of importation to the market shall get deducted from the Indian market price for determining the value at Indian port, and the value so determined after deducting such expenses will be known as deductive value, which shall be taken as your assessable value given under Rule 7. So lawmaker says कि either take out the breakup cost of all the pre-importation expenses and compute its aggregate for determining the AV, or sell out the goods in Indian market and deduct all post-importation expenses therefrom under Rule 7. However, if such goods does not get sold in Indian market within 90 days from the date of their importation, as well as exporter is not ready to share his breakup cost with you, that is, neither Rule 7 nor Rule 8 can be applied. Although Rule 6 says that there is no need to proceed sequentially under Rule 7 and Rule 8. That is, Rule 8 computed method can be directly applied without applying Rule 7, where exporter is ready to share the cost with you. But what happened if Rule 7 and Rule 8, both of them cannot be applied? Because under Rule 7, goods are unable to be sold within 90 days, and under Rule 8, exporter is not providing you his breakup cost. Then lawmaker says that by proceeding sequentially, Rule 9 shall be applied. And under Rule 9, it's very simple that assessing officer gets power to determine the assessable value on the basis of his best judgment. He shall conduct the best judgment assessment on reasonable grounds. The grounds on the basis of which he is computing the duty must be reasonable enough, and such grounds must be given in writing by the assessing officer. If the amount determined by assessing officer on reasonable grounds given in writing is found to be sufficient by the importer, then importer can accept this value for determining his duty. And the value so determined by assessing officer under Rule 9 will be known as residual value. Such residual value shall be taken as assessable value under Rule 9 for computing duty. However, if assessee is not satisfied with the value determined by officer, he found it to be very expensive, then assessee have an authority to file an application and appeal to the court, to the respective authorities, adjudicating authorities, for determining the value thereupon. And the value so determined under these rules shall be taken as AV upon which duty shall be computed thereupon. Okay, so on a brief, we can conclude that under valuation rules, these rules shall be applied sequentially. First of all, Rule 3 shall be applied only if all the conditions under Rule 3(2) are being satisfied, subject to Rule 12. If Rule 3 cannot be applied because either the conditions under Rule 3(2) are not given or the value has been rejected by the assessing officer under Rule 12, then by proceeding sequentially under Rule 4, the value of identical goods shall be taken as the assessable value. If identical goods does not exist, then by proceeding sequentially, value of similar goods shall be considered as AV. If even similar goods are not available, then Rule 6 says that after Rule 6, 7 need not to be prevail or need not to be proceed sequentially. You can directly go to Rule 8 if the exporter is ready to share his breakup cost, wherein all the breakup cost, the aggregate of all the pre-importation expenses shall be taken as computed value under Rule 8. However, if Rule 8 cannot be applied, then you can vice versa move to Rule 7, wherein importers shall be liable to sell such goods in the Indian market within 90 days from their importation, out of which all the post-importation expenses shall be deducted for determining the assessable value at the Indian port. But if both these rules cannot be applied, then by proceeding sequentially under Rule 9, assessing officer shall have the power to apply his best judgment on reasonable grounds given in writing for determining such value, which is known as residual value, which shall be taken as your assessable value. Okay. So beta, as of now, we'll conclude the topic, we'll conclude the class today, we'll conclude this session, and all these rules we'll conduct in detail after applying these rules in the practical questions that we will see in next session. Till next session, goodbye and God bless you all, and do revise whatever we did as of now for the further reference while doing all the practical applicabilities in the questions. Okay, bye bye, take care and God bless you.